Welcome to today's webinar. And go ahead, Anna, give me the screen. Give me the screen for the, well, all right, I'll go in with our guest. There we go. A banking reset. Trump's impact on regulation, M&A, and market outlook. And I will be more than happy. John asked me to come at the end and talk about my thoughts about the SBA and the new administrator. I'll be happy to do that. John Whitting, founder, Clark Street Capital, is your moderator. We have Josh Siegel, CEO of StoneCastle, Umrai Gill, Managing Director, Performance Trust Capital Partners, Michael Mancusi, partner of Arnold and Porter. John, let's real quick. We are recording this. This is on YouTube if you want to go back and do that. But John, real quick, I want to know, why did you choose this topic at this particular point in time on the calendar?
Well, I think with so much going on in Washington, we could probably do this every week.
You could do another one this afternoon.
Yeah.
The way the news is coming.
So yeah, I thought it would be good to cover both the bank earnings and as well as the new administration.
I'm gonna hijack it real quick. I need to know, 30 seconds, what your thoughts are on CFPB.
I mean, I think that the CFPB has a different approach to all the other regulatory bodies. They're more like the Justice Department. It's very antagonistic. So the bankers all hate them. And it's, in my opinion, caused banks to leave consumer lending, which has reduced the number of consumer lenders. The less competition, ultimately the worse for the customer. So I don't think the CFPB has been useful.
Very succinct and very right on. Good analysis. All right, go ahead, John. Take it away.
Yeah, so we're going to start with Umrai Gill of Performance Trust, who is going to give us a recap of bank earnings. The last time we had Umrai, the last two times we've had him, he's talked about the state of unprofitable banks. At one point, his firm was predicting 500 some odd unprofitable banks. So good to have him back here to tell us what's going on.
Thanks, John. I am just navigating here this PowerPoint. So for everybody watching, you're about to go through what we at Performance Trust call our Q4 2024 Insights Report. So for those that were on with us, John, what was it, 2023 or late 2024? PT had really projected forward what would eventually happen in the industry, or what our prediction was in the industry around what could happen to bank earnings, given the significant move in rates, significant move in liquidity conditions, which we're sort of on the other side of now. So real quickly, just getting us up to speed, linked quarter earnings, Q3 2024, I'll call it then. This is linked quarter, so Q3. You can see this is the distribution of earnings in the industry. And what we're measuring down below on the x-axis is pre-tax, pre-provision ROA. So you can see for all banks above $125 million in assets, this is what Q3 looked like. If we fast forward to Q4, I'll call it then and now, you can see that earnings actually bumped up in a particular part of the distribution, which is at 125 to 175 pre-tax, pre-provision ROA. We're still off the highs in terms of the really high earners, but we've sort of arrested this distribution moving right to left, which we'll talk about how that happened over the last couple of years. So looking at it in tabular form, you can see that the number of institutions in the, call it, below cost of capital earnings bucket, you can see 25 to 75 basis point ROA, pre-tax, pre-provision, 75 to 125. The number of banks there went down. The number of banks in that 125 to 175 area actually went up, which is a really good thing. So Q3 to Q4 earnings improved, but we still got a number of institutions, call it 300 or so, and a number that are entering into this bucket that are really in tough shape. So that's Q3 to Q4. If we look back on the Q4 22 to Q4 24, this was what the industry was then. you can see the distribution. Most institutions were all the way to the right, really good earnings position. And today, so that was then, this is now, you can see that the distribution is skewed toward the left. Now, we had mentioned in a white paper that upwards of 1,000 banks could be unprofitable. It's landing in about a third of that. There's a lot of reasons for that, namely what we would describe as survival adaptations that a lot of these institutions went through during the period of time. So forms of defense, if you will. But make no mistake, if you look at where we were then and where we are today, the better Q4 earnings are still a step function below where they were before this cycle started. Last thing I'll do, and then I'll kick it back to you, John, is if we dissect the trends of pre-tax, pre-provision earnings, landing at about a 129 in Q4 24, down from about a 145 before the cycle, namely the rates and liquidity changes. You can see that that number is a byproduct of really two things. One, a slightly improving margin, 318 to 325 linked quarter, but sort of the tug of war with a net overhead ratio for the industry that actually ticked up. And for those that aren't familiar with the term net overhead, think of it as net non-interest expense divided by average assets. So while the margin did improve, there's still a treadmill of expense that the industry has to contend with. So I will kick it back to you, John. That is a quick and dirty of the linked quarter as well as the last 2 years.
Yeah, I mean, that was a great summation. When you look at the 2022 to 2024 data, keep in mind the end of 2022 was basically when rates started moving in the other direction and profitability started becoming squeezed at banks. So obviously that's where that's comparison. Josh, we've talked about bank earnings. You've talked about a tale of two cities. What do you mean by that?
Well, you still have, quite a disparity between the larger banks and the smaller banks. It's not one universal fit. When you talk about smaller banks, they're still definitely having challenges finding cost-efficient deposits, and that's across the whole space. The deepest well of deposits that we can all observe, for example, is the broker sweep market, which is hundreds of billions of dollars. In normal times, it ranges at Fed funds effective plus 20 to 25. Right now, it's down to Fed funds effective plus 5 to 7 basis points. They're just large banks don't need the funding. They're fine. Small banks are still struggling to find funding. You also have that tale of two cities in terms of, let's say, the perceived credit exposures, right? And I think we'll talk about this a bit during this call, right? When you look at metropolitan commercial real estate versus secondary, tertiary market commercial real estate, different outlooks on the embedded losses in those portfolios. So it still is very much, you have to look at each bank, each market very specifically, because this is not a case where, a rising tide floats all boats. It may or may not. Some boats might have holes. And that's something that has to be really dug into case by case.
So what do you think happens to these unprofitable banks? What's the end game? It sounds like, your firm's prediction from a couple of years ago, they've maneuvered, but, obviously, you mentioned at least almost 300 are still basically unprofitable. If rates stay high this long, how do they dig themselves out of this?
Well, I don't know if you're asking Umrai or me. But
Umrai, sorry.
I have thoughts too, but go ahead, Umrai.
Yeah, thanks, John. So I'm gonna point you to something that is really kind of got brushed under the rug, but I don't know if our audience realizes this, but there was an FDIC assisted transaction that was announced in January, 3 weeks ago. Now, it was a very, very small bank, right? So it didn't hit the headlines like Silicon Valley did or Signature. But what it is, it's an overhang from the severe balance sheet problems that many of these banks have. So, John, that would be an example of one extreme outcome. The previous FDIC assisted deal was the Republic First deal. Probably we shouldn't call it a deal, but the Republic First transaction. And so there may be more of those out there where the impairment, because it was driven by interest rates and liquidity, might have felt temporary, but really is more of a permanent impairment. There's going to be a lot of institutions, John, that are, of that 300 plus that may not be making money, that start to make a little bit of money, right? So they're not eroding capital, but they're economically insolvent. In other words, they're not earning enough for their shareholders. They may be earning enough for regulators, but they're not going to be earning enough for their shareholders to justify their independence. Yet they can't really do a deal because if you do mark their balance sheet, there's insufficient capital. So they're what you would call a category of zombie company that can last for quite a while. Because if the regulators are saying you're okay, we don't care how much you earn, but you're not going to, risk our deposit fund, and shareholders can't get out, you have a bunch of trapped capital. So there's going to be a lot of that. And then there's going to be those that really turn the corner, like we see quite a bit out there, where they get back to profitability, but it's that step function of profitability lower than where they would want to be. And they can't really get their costs down. But their balance sheets are getting healthier. Those are really good candidates for deals. They can't get escape velocity, and they're no longer impaired.
Josh, you had some thoughts on that?
I don't disagree with anything that Umrai said. I'd say our best guess is going to be the law of thirds for this group. A third of them probably fail. I think we will see increased failures in the next 24 months. I think a third will, just by the passage of time and the duration of the loan book working its way through the interest rate cycle, right, as things mature and roll, they'll come back to some better level of profitability. But I agree with Umrai, it's not going to be back to 100 basis points ROA. It's going to be less, but sustainable. And then there'll be a third that are attractive enough that it's worth someone buying. And I think that's how that group will work itself out. I don't think that they're all going to fail, and I don't think they're all going to get acquired. It's probably going to be about a third, a third, a third.
Yeah, Umrai, I've seen anecdotal evidence that more banks are taking the hit on their securities portfolio. Associated in Wisconsin, good example of that. They sold a combination of 2% securities and 3% mortgages. There's a couple others. Is that a trend where they're just acknowledging rates are going to stay elevated, so let's take the hit and be more profitable going forward?
Yeah, it's a great question, John. PT, we've actually done quite a bit of work on this type of repositioning, and the way we would encourage folks to think about it is be careful looking at a headline transaction that feels and looks the same, right? Let's issue capital, sell some low yielding assets, reinvest higher, and think that they're all economic equivalents. There are deals or repositioning strategies that we see where, if you think about it, there's really three legs of that stool, John. There's what cash flow you're selling. I'm not talking about what yield, right? That's a big mistake. What cash flow? How long is that yield on the books? How does that instrument change? What you're reinvesting into matters. There's banks that we've seen reinvest the wrong way. So they thought they were solving a problem, but they were really creating a new one. And it also matters at which price you're raising the capital.
Yeah.
So not all capital ratios are equivalent. So I would say, John, there's a short kind of sighted way of thinking about the transaction where people think they're curing a problem. And then there are those that really are curing a problem. So I wouldn't call it I would call it maybe more of it's happening for sure. I don't know if that makes a trend, but not all of it makes sense.
Yeah. Well, we have a poll question we're going to queue up. And while we're doing that, Michael, our man in Washington, what's going on with the CFPB? Chopra's out. People are told not to work. Maybe you can shed some color on that.
It would, I guess the situation changed pretty dramatically every day. I mean, even yesterday, the head of supervision and the head of enforcement both resigned, stating that the shutdown doesn't allow them to fulfill their missions. So, what we've heard, what we've seen with clients that have active matters with the Bureau, and just anecdotally, um, everyone is pencils down at the Bureau. They're not allowed to answer phone calls, check their emails. There are fairly very strict standards and that were imposed on them. But there was a signal that there may be some new enforcement priorities forthcoming. So it perhaps may not be the death of the CFPB, but certainly it's a pretty significant pivot, and we'll see. We'll have to wait and see where things end up. I think it's part of the whole President Trump's whole consolidation of power into the executive branch, even if the legislature or the courts may have differing views.
Yeah, so the poll questions come in. Only 2 people said no change. 2/3 said moderately less regulation. A third said significantly less regulation. Are you folks surprised by what our audience is thinking?
Nope.
Yeah, not a real surprise yet. I mean, I think there's too much uncertainty right now to really be able to have any foundation to say one way or another here. There are too many agency heads that are either just been appointed or still in the acting capacity. I think there's going to be some time before things really shake out.
Yeah,
It's been like 5 weeks, and it feels like it's been a year. So,
Mike, what do you think about if I go back to one of the slides earlier that was in our insights report, the sort of the headwind of cost structure. Regulation is normally spoken about as a headwind, right? Not a tailwind.
Right.
Do you see cost relief?
I think there's a strong possibility that there may be some, but even when you look at the change in administration over to the first Trump administration and then back to Biden and now back to Trump, your line examiners and supervisors, they're all still the same people, and yes, there may be new directions that the leadership of the agencies take. Your typical supervisory, reviews and stance on safety and soundness, et cetera. I don't think changes drastically. Enforcement focuses change, but your day-to-day supervisory positions from the agencies don't typically swing that far. That said, I think there's a good likelihood that there will be some easing of regulatory burdens, which may help on the cost structure, but I don't think it's necessarily going to be the monumental swings that we've seen the pundits talk about.
Yeah, I don't think it's going to be particularly evenly distributed. I mean, it's fairly obvious that Capital One is like the greatest beneficiary of this. One, they've got a big merger, so obviously that helps. 2, they're heavily consumer oriented, CFPB, and 3, they're subject to these higher capital rules. Question I have is, what does this do for the $5 to $20 billion commercial oriented bank, right? They're either CRE, CNI, et cetera. Will they see much of a change at all?
I don't think so.
I don't believe so. I think Josh shares that view.
Yeah, I don't. I think you're going to see minimal. I mean, to Umrai's comment on costs, from when I talk to bank CEOs, it's not that they're getting so excited to lay off some of their middle office people doing regulatory work. It's that if CFPB goes away and regulators pull some of what we all might consider superfluous reporting that has to go back, it's not going to change the cost structure of the bank, but it will allow management to reallocate those people to higher value functions. So either better risk management, like credit risk management, or generating new business. So I think the cost structure remains, but the top line might be able to rise, or the provision hit could decrease.
Michael Umrai, any thoughts of that, of being somewhat imbalanced, not helping everybody?
Yeah, there's
Yeah,
go ahead, Michael.
I was gonna say, I agree with what Josh is saying. I think it would be difficult to pull a large number of folks from compliance that are there. I don't think the OCC or the Fed or the FDIC are gonna change their stance markedly on enterprise risk management and the importance there. The OCC's supervisory operation plan, while released before the change in administration, the themes there are fairly consistent for the last 4 or 5 years.
Yeah.
John, history is always an interesting teacher. So if you look at 1980, right, change of administration, change of tone, we went to a very deregulated industry. Now, at that same moment, I'm sure if we had the same poll, people would have said regulations are going to be eased up and we're going to have all this growth. And then it was so deregulated that the industry got itself in trouble, right? It had the savings and loan crisis. And then, of course, the regulations came back double what they were before. So I think we all have to be a bit cautious that less regulation does have benefit, but there always is a component of irresponsible actors who take advantage of that, which could create another situation where the tide goes back the other way very quickly. So no celebration before we figure this out.
What do you think happens to Wells Fargo? I mean, I would not want to be competing with a fully unleashed Wells Fargo after they get out of this asset cap. I mean, they're going to be a very strong disruptor in their markets. In Chicago, they're adding 30 branches now. What do you all think happens to Wells? They get out of this asset cap soon?
I think so. I would agree with directionally what you're saying is it is the larger banks, it is the capital ones, it is the Wells who I think do benefit most from an easier regulatory framework. And it will allow them to be more aggressive.
Yeah, I couldn't agree more, Josh. In fact, there's a kind of a poster child for regulatory hand slapping and regulatory sort of, they've had a lead balloon on them, and that's Citibank. And you'll notice from the earnings, Q4 2024 earnings, and the market's priced this into a lot of these bank valuations, but they announced a $20 billion buyback. That's 15% of their tangible equity. So put it this way, the capital build cycle, that was very much regulatory driven for many, many years, and these cycles last a long time. So this one in particular is probably, we're in our 15th this year, is now probably peaked in terms of the amount of capital that these banks believe they need to hold. And they're starting CET1s, Citibank was almost 14, JP Morgan's 15.5. Investors are recognizing that capital is going to now be able to be returned in pretty significant size. That's a real shareholder value benefit. On the small bank side, just when I heard you talking earlier, John, you mentioned the $5 to $30 billion banks. The other area where regulatory may be, maybe not an explicit cost reduction, but an economic cost reduction is in the probability of approval and timing of approval to do deals.
Yes.
And that is the primary mechanism by which the industry is going to reduce its cost structure over time. One case in point, last thing I'll say is if you look at the Atlantic Union Bank Sandy Springs deal, that's a $25 to $30 billion bank buying a $12 billion bank. A lot of commercial real estate concentration in Sandy Springs, which blew up the Home Street deal. That on February 5th got all regulatory and shareholder approvals. And it was announced, I think, in October.
Wow, that's a lot faster. Michael, on that note, I mean, you think a third or a half reduction in approval times for bank mergers?
I think while we'll see the time speed up, I don't necessarily think we'll cut them in half. There have been two pretty quick approvals so far this or at the end of last year, beginning of this year. But I think because of the rhetoric coming out of the administration, there certainly will be a speed up in the process. But will it be half the time, a third of the time? Yeah, maybe somewhere in between that. But it will be significantly reduced.
Yeah. Well, the administration is starting to get its people. I would say the OCC head is probably the most significant hire from a bank regulatory standpoint, because obviously changing Powell or changing the FDIC, there's a little bit more time involved. Thoughts on Rodney Hood, former NCUA head, as control of the currency? Michael? He used to be enforcement. Michael used to be head of enforcement at the OCC, so he knows that body well.
I appreciate the promotion there, not the head of enforcement, but in any event, Mr. Hood as the acting controller, I think was a little bit of a wild card, and wasn't really mentioned at least in the circles as potential as the controller. He's serving as an acting controller because he had previously been approved by the Senate for his role at the NCUA. But you see President Trump building out his team with very staunch supporters, and so you wonder what that may mean or what that may signal for the replacement for Governor Barr for supervision at the Federal Reserve. The presumptive pick was Governor Bowman. Maybe there'll be another wild card there, as well as acting Chair Hill. I guess it raises more questions than certainties to me on whether or not he may be tapped in a permanent role. So I think what that shows is it's important for, again, to go back to a theme I talked about earlier, the consolidation of power in the executive branch. There will be strong allies at the tops of these agencies that historically are supposed to be less influenced by the political winds, but certainly what we've seen in the early weeks of this administration is they'll go through extreme efforts to promote their agenda.
I mean, Barr, to his credit, before he left, they were already backing off from these revised capital rules, and he noted that the comments were the most negative they've ever seen in a rule. Josh, where do you think that stands? Obviously, that's a big issue for regionals.
There's a couple of things packed into that question. The whole Basel III endgame question, I do think that had gone a bit far. I mean, again, I always love the line that regulators tend to fight the last war. And so all of the focus on Basel III and capital rules ignored what led to First Republic, SVB, et cetera, right, which was a duration and a liquidity problem. So that's great. We could ask for all the capital in the world. That didn't prevent three massive failures. So maybe that isn't the end game, no pun intended there. So I think there is going to be a rethink of where and how capital rules, how does Siegel play into that? Because, of course, reserves are capital, right? You put it into a different box on a call report, but it's still capital. It's a loss absorption. And I think Siegel did, whether it was really planned to this extent or not, a very good job of building up additional reserves. We haven't seen the credit cycle come through yet, but even if it did, even if it was 2 sigma to a prior cycle, the banks are in such a better position to absorb that compared to 2008. It would be, I wouldn't say it'd be a non-event, but it'd be a very small event. So I don't see that being much of the issue. To your point about the new OCC chair, there's an interesting dichotomy there. One is you're taking a head who was mostly focused on consumer-oriented financial institutions and predominantly small financial institutions. So the challenge that that head will have is the scope and nature of the institutions predominantly regulated by the OCC, which are far more capital markets focused, international payments focused, commercial C&I, CRE focused. So that's the challenge. The benefit is it's going to bring a new lens to the OCC in making sure that we're preserving the function of small FIs, of small banks around the country. Because yes, maybe the largest donors to lobbyists are the top 5 banks, but when you come to members of Congress, the count of small banks, which do 48% of small business lending in this country, if they start drying up because there's too much focus on the largest banks, you're going to feel that in the voting booth. So there's going to be an interesting back and forth with a very new perspective from this new OCC, and I think the jury's out of how that's going to play out. But it's going to be different. It's not going to be the same.
Yeah. Umrai, any thoughts on the new capital rules?
Not a lot to add there, John. I'm going to say something that puts me at risk with bankers. The CECL framework that Josh mentioned, I think is going to have its intended result, which is to associate or to couple, I'll call it recouple, a lending and credit decision with the cost of the risk. So banks get into trouble over time, a number of different ways. Asset liability has been a big one this go around, but the real holes tend to be on the credit side. And if you force an expense in alignment with a risk decision, you'll get less, I'll put it in air quotes, misbehavior around seeking short-term income because you're just forced to take some expense. And I think over time, that's a good thing. And it will force institutions to make capital allocation decisions more intelligently around the risk. So that's a comment on CECL, I guess, John, and not the capital rules. Over time, the industry will still need to find intelligent ways to reduce this cost structure. Its net overhead ratio is the preferred metric that PT looks at, not efficiency ratio. And happy to go into that with any of our audience members at a future time. But that is a true competitive advantage of scale. But you can still blow holes in your balance sheet even if you're big. So that's why the industry tends to be hard over time and really requires the right frameworks.
Yeah, so we have a poll question, and people have been already filling it out. What's your bank's attitude towards M&A? Highly likely to acquire or be acquired, moderately likely to acquire or be acquired, or little or no interest. Let's give it a second. While we're doing that, Michael, could you say there's some immediate impact on the Trump effect on M&A, or too early to say?
I think it's a little too early to tell. I think M&A activity will speed up. I don't think it'll be the opening of the floodgates that some were predicting. I know the conference in Arizona a couple weeks ago was pretty euphoric attitude there, but I think there still needs to be some time for the new heads of these agencies to get their staff in place and to get the direction and the directives in place that they're going to focus on. Again, we'll see approvals speed up. The number of deals, I think that may be a little bit more a lag than see the immediate result there.
Yeah, just in looking at the poll questions, what stands out to me is 37% at this point of little or to no interest in either being an acquirer or a seller. But the rest are either moderately likely to acquire or be acquired or highly likely. So perhaps that's the sample size here. But I mean, are you seeing more conversations in boardrooms, Michael, about M&A?
I think there's a lot more opportunistic discussions in boardrooms as opposed to some discussions that there may have been in terms of, regulatory fatigue. So I think that's been a nice change. People are looking more strategically as opposed to kind of throwing up their hands and saying enough's enough. So I think that's been the most immediate impact that we've seen.
Yeah. While I ask this next question, if anyone has any questions, ask them in the chat function. Josh, last week there was a renewed push for de novos. I think you mentioned a stat, how many de novos there were before 2008. Do you think that would help? I mean, is it a question that it's just too hard to get a de novo started, it takes too long, or is there something problematic with the idea to begin with? So curious your thoughts on de novos.
Well, in the 2 years leading up to 08, you had about 540 de novos. And the pace in years before that was still quite robust, 50, 100, 150 per year. But I think if you have the ruler on your knuckles every time you reach for the cookie jar, eventually you stop reaching for the cookie jar. And we've had such a long cycle of just penalizing process in trying to get a de novo, infinite waiting, infinite questions, raised capital standards. It has completely discouraged entrepreneurs from trying. So you have very few left. And I do think that is not a good thing. I think that there are markets that could use a lender who's very locally focused. I think there are subsectors of affinity that could use different institutions, but very few want to try when over the last 10, 15 years, there have been amazingly deep wells drilled with no oil at the bottom. And not because it wasn't there, it's because effectively the fatigue in drilling just finally had them walk away. So I am hoping, I don't have any reason to be hopeful, but I am hoping that de novo activity picks up and that the regulatory construct sets clear guidelines, more expeditious response times, actually probably required response times. It's fine if you say no, just say no. The problem for many de novos is endless questions with no yes or no at the end. So I think there is a need. I think that the industry would benefit, but I don't know how hungry entrepreneurs are to try again unless something meaningful changes and something demonstrative is set forth as a construct.
Yeah, John, there's been some signals from the FDIC about their openness and willingness to approve deposit insurance applications and also consider structures that under the previous administration may have been taboo, like ILCs. So again, there's the rhetoric is there, and the signals are there that the regulators will be open for business. It's just, as Josh pointed out, the guide rails need to be set. The rules of the road to move forward and how to accomplish that they need to be addressed. And again, that's going to take a little bit of time.
The desire for capital to go into that economic model is very low, because another way to think of it is, imagine you can buy a building for lower than it costs to construct the building.
Yeah.
You wouldn't go building a bunch of buildings. You'd be choosing something that's already built. And our industry has had a dearth of capital for a while. Maybe that's loosening up, but where valuations are to buy something that's already created, already built, doesn't really make a tough argument for you to capitalize a de novo, even if you had no regulatory constraints.
Yeah. Mm-hmm. Josh, I know you've said in the past that regional banks are kind of stuck in the middle. They're not nimble. They're not as big as the largest banks. They can only compete on price. How's your thoughts on that topic changed in the past year? I mean, it does seem like some large commercial borrowers, or a lot of them who move their money from the regionals to large banks, have kind of brought them back to the regionals. thoughts on how regionals fit in better or worse than maybe a year or so ago?
I would say at the moment, the exact moment, generally in the same boat. I think that you have a couple dynamics that are affecting regionals, and I'll break regionals into two types: diversified regionals and kind of call it a super community bank type regional, right? Where you're still locally focused, locally lending, branch network, right? That might be a bit different. East West, for example, is an example of something like that. It's still a community bank. It's just the size of a regional. A Webster, similarly as well. So that they're different than a Truist or someone like that. I think the challenge the regionals have is it's still the same construct. They don't have the breadth of service or scope of a money center. They don't have as strong a connection, although I see some of the regionals trying to redefine themselves to be more local and be more focused. But now you have this whole private credit situation, right? With a gargantuan capital markets industry that is rapidly turning its attention to going after the C&I business that typically would have gone to regionals. Is that going to be the death nail? No, but it's more pressure to those lenders than was there a few years ago. So I think that's going to be a challenge. Now, the flip side is, as we talked about earlier in the regulatory construct, I think the ability to get mergers done at that scale is going to be far easier in this administration than in the prior. And so I do think there's a higher likelihood of regionals teaming up to get to that critical mass and then adjusting their models to become more competitive. So I do think the mid-size will shake itself out, or at least has the opportunity to shake itself out in the next 4 years in a pace that we hadn't seen in maybe the last decade plus.
Those are really good points, Josh. I hadn't thought about personally just how many capital providers that segment competes against. Up, down, bank, non-bank.
Yeah, it's hard.
I mean, when you see the charts on private credit's share of mortgages, mortgage servicing, commercial real estate, I was actually stunned at what a big presence private credit was making in the C&I space.
Yeah.
I mean, I know there was chatter that a Harris victory would lead to regulation of private credit. I mean, what do you all think of private credit as a threat to the banking model as they keep growing?
Again, my view is there's two things: is private credit isn't terribly efficient at small scale. So if we just treat every bank with equal weighting, not by their size, to the industry, it won't have a very large impact in the count of banks, because most small banks are not competing with private credit lenders. But when you get up to a super community, a regional, and a money center, yes, you are, right? Commercial real estate, C&I, even consumer is starting to find inroads. And these are not small entities, right? Apollo, BlackRock, they're massive. And to some extent, like a BlackRock dwarfs JP Morgan. I mean, it's quite hard to even fathom the scope at this point. So I do think it will have quite an effect on the regional and money center space. And they are going to have to be creative as an industry to figure that out. I don't think it's going to have much of a direct impact on smaller banks or mid-sized banks, but that's my 2 cents on that.
Hey, John, when I hear private credit and at Performance Trust, we obviously serve the banking industry, but we also have an asset management firm. The big difference between banks and non-banks is cost of capital.
Oh, yes.
Now, banks have an advantage, right? Because they get to raise deposits at or below the treasury. And in exchange for that, they absorb the cost of a smaller, tighter box called regulation, of which they can operate. And so to me, the private credit maybe influence may have some, may rhyme with kind of credit expansion in the non-bank space of the past, where the way they're competing is knowing that they have a higher cost of capital is they're willing to do things that maybe banks wouldn't want to do or can't do. So in a weird sense, it's one way to look at it. While they're competing, they may also be absorbing the risk away from the banking system. So to me, that could, if one agrees with that, that could mean the banking system could actually be healthier for when the next credit whatever hits,
Sure.
but still is challenged with a inflated cost structure and profitability challenges.
John,
Yeah,
another, John, another question for you on that front, because the main topic of this was about the new administration. Jury's out on where private credit will stand. I mean, there was this comment yesterday. I lose track. I mean, it could have been yesterday or a couple of days before about the carried interest tax treatment changing.
Oh, yeah.
So that's very not private capital friendly. So I'm not sure where this administration's view yet is on private capital.
Yeah. Well, I think I sometimes brush off the private credit versus banks because, you know, for every $100 private credit lends out, there's probably a bank lending 75 cents on that. So, you know, they work more hand in hand from a practical standpoint than a direct competition. And you look at the last couple of quarters, the loans to non-depository financial institutions have been some of the fastest growing areas in banks' balance sheets. So, you know, we're certainly seeing them work in unison. Mike, a lot of chatter about new CRA rules. I guess that the bankers sued and this case is going on. I have no clue what's going on with new CRA rules. Maybe you can help us.
Yeah, so the agencies issued final CRA rules that supposed to take into account the metamorphosis of the banking industry and the delivery of products and services in today's day and age. Those rules were challenged in court. There's an injunction in place from enforcing those rules, and depending on what happens, they'll either go back into place, but in the banking industry will have, you know, right now it's already a little over a year to comply because you get a day of dispensation for every day the injunction stays in place. But the real question in my mind is not necessarily where will the courts shake out on this, is where will the administration shake out? You know, like if you look at what happened or what's happening at the CFPB, their lawyers were told you can't even go to court unless you have special permission. And one thing that could happen is the rule could essentially be revoked by the administration's decision not to go forward in defending the case or you know, litigating the case. You know, I think the CRA was part of some of President Trump's campaign rhetoric, and that he was in favor of some type of reform there. So it'll be interesting to see whether they move forward in defending the case, or whether they start working on a revision of rescinding and revising the rule. You know, the calculus is a little bit strained there because you know, that was 7 years in the making for the other federal regulators in creating this new rule. So
it would just go back to what it is now.
No.
Essentially, it would go back to what it is now, and then you know, either they go back to the drawing board, or they continue to fight for the new rule, which has its challenges in itself. That could be the subject of a whole nother webinar.
I mean, they could just rescind CRA.
Good.
Yeah. Well, I mean, it's interesting when you look at President Trump and where he's gotten his loans the last few years. There's one bank in California that has been lending to him. That's about it. It's been the ladder capitals of the world and private credit. So, you know, the president doesn't seem to be on great terms with the largest banks. This probably goes back to his issues of the 90s. So it's not clear where his sympathies lie on that note. Umrai, NYCB, they've been digging out of their issues, New York City multifamily, had a recap last summer. Looks like the stock price is more than doubled since. What's going on over there? Because it's really still the most high profile, I won't say troubled institution, but institution with some high profile troubles.
Hey, John, real quick, before I answer or give you some thoughts, I just need to correct you for a second. It is no longer NYCB, it's Flagstar Financial.
Yeah, of course.
Yeah. Yeah, so clearly a name change to kind of move on in life, I guess. And I'd say, not full disclosure, not working with the bank directly, but observing from afar. I would say it was probably the poster child of this kind of cycle in banking that out of the gates got way less attention than your asset liability bedfellows in Signature and Silicon Valley, but was a balance sheet that sort of had all of the risks. It had a very, very large concentration of CEs, rate sensitive money, and a huge concentration of commercial real estate, right? A rate sensitive asset class inside of a jurisdiction that was undergoing some stress. So there's no doubt that it needed more capital. It got the capital it needed. They assembled a team that is sort of the who's who in terms of being able to get regulatory, I'll call it runway. And if you add all of those things together, as they're deleveraging the balance sheet, the stock is up because the probability of further dilution and or a takeover is probably pretty de minimis at this stage. So the market's viewing the distribution of outcomes to be heavier weighted for them to eventually earn money again. And where the valuation gets back to tangible book value per share, where it's still at a discount, I believe, is when the market sees on a go-forward basis that their earnings power puts them at a 10% return on tangible equity. So I think there's a belief that that's going to happen today, given that I think we can underwrite as a community the rate piece. I think we have more visibility into cost of funds. And maybe we haircut credit, but they pumped it with a bunch of capital, so there's some margin of safety there. So that's all I know about that situation, and I feel like all those negative forces are loosening for them.
Yeah. Well, I still call it the Gulf of Mexico. Gulf of America is going to take some time. I'll get there eventually. Crypto and marijuana and banking. Any thoughts? New administration attitudes towards, well, we know their attitudes towards crypto. Marijuana is a little unclear, but thoughts, Michael?
Yeah, I think certainly there's consensus on the crypto side. I think of some of the issues, crypto or stable coin. Those are some that there at least is some consensus out there that that this is coming. I don't think banks will dive into the deep end immediately, but there clearly is gaining acceptance for crypto. You're always going to run into the BSA AML concerns related to crypto and servicing the marijuana industry, but we've seen banks successfully get into and serve the marijuana industry over the last few years. So I think there's guarded optimism is how I'd put it.
Yeah, the AML BSA side is likely not going to see any loosening with this administration, and so that's not going to change. The other thing I would want to point out, though, John, is saying crypto and stablecoin in the same sentence is very apples and oranges. Crypto is at its core, I mean, people can have a view. It's still just betting, right? Stablecoin is just a tokenized deposit. Now, it could be a tokenized money fund, tokenized treasury, tokenized cash, but that's just a payment medium, which is a store of value that actually tracks something of third-party reference. So they're very different things. I don't know if I'm seeing so much easing on the view of, oh, banks should be investing in crypto or holding crypto because the volatility of that asset. Lending on it, TBD. Stablecoins, you can see with Chair Hill, who even before this administration was pushing a stablecoin bill to try to allow banks to get more involved in that part of it. I do think there is a consensus that banking will get more involved with digitized dollars. Call it what you want, because that's going to change. But it doesn't, to Michael's point, it doesn't change the still concern around BSA, AML related issues, which are real. It's not fantasy. I mean, there's a reason Tether still operates offshore, right? And is one of the now quite significant owners of U.S. Treasuries. So it's going to be an interesting area of how that plays out. I think on the marijuana question, given that the last administration was friendlier to the legalization, I don't know if this administration is. We don't really see a formal position. The great challenge, of course, with cannabis banking is, you're effectively breaking the law if you're trying to use a federal rail to move the funds. So I don't know if that's going to ease under this administration, whereas, again, the crypto side or stablecoin side probably has more runway.
Yeah. Umrai, any thoughts on crypto marijuana banking?
No thoughts on either, John.
I'm going to bring our gracious host, Bob. We've got a new SBA administrator, got a lot of community bankers here, some SBA lenders on the call. Thoughts on the new administrator?
Before I get into that, I think you have a whole webinar on Josh's throwaway line, which is CRA may go away. That's a very powerful statement, Josh. That's anyway. John, you need to explore that. Hey, in answer to your question, she will be confirmed. The Senate's playing their cloture rules or whatever. She will be confirmed. It is good news for the industry for a couple of reasons. One, she was a senator during the PPP implementation. She knows SBA. She knows how to spell SBA. There is a huge problem with a book of assets on banks and non-bank lenders on unforgiven PPP loans. The problem these lenders have is they can't get the money back from the Treasury because they're not unforgiven. SBA is alleging that these are fraudulent loans, and that's fine, but the banks clearly had a safe harbor when they made these loans.
Yeah.
So on the balance sheets, number one, their assets, they're getting no interest on that, and they're looking at a big hole in that will bankrupt several major non-bank lenders if it's not solved. I'm optimistic on that. It was announced today that Thomas Kimsey, some of you may know him, president of Thomas Financial, he took over. They were part of the consortium who bought out Mike Thomas, big time USDA lender. I think that's great also for the industry. He's going to be the SBA Associate Administrator of Capital Access. I love his description. I asked someone, and they described him as a Southern gentleman, very low key, no flash, but passionate for Main Street. And this is a guy, he's president of a major financial institution. He's taken a big pay cut to do this job. He's certainly not going in to feather his nest. So my quick response to you, I'm optimistic. And my final thought on that is remember what Project 2025 said, even though it was disavowed, that their Project 2025, but the Heritage Foundation said, hey, we want SBA 7(a) lending to go up to $50 million guarantees for construction of manufacturing. So
interesting.
Other than I think PPP was got to be solved. Otherwise, you're going to have major problems. Go ahead.
Well, once again, great group. Michael, thanks for joining us. Bob, any closing thoughts?
I want to hear more about Josh and CRA. That's what I want. I have one more closing thought if you want to hear it.
Sure.
there's a lot of weird stuff coming out of California. I don't know if you're following it, but beginning July 1, state of California through DFPI, which I call CFPB Light, has said any commercial loan under $500,000 is to be treated as a consumer loan.
Oh, wow.
And all those consumer protections for California lenders are going to be in play. So
Interesting.
Yeah, that is very interesting.
Now, also California to keep your eye on is obviously there was a huge amount of resi real estate that vanished, and a lot of it was not insured. So that's on somebody's balance sheet.
Yeah, that's why the insurance losses are going to be manageable, because so many of those homes, unfortunately, were underinsured or not insured at all.
And they were jumbos, which means the banks were holding them.
Yeah.
Josh, that affects me. I lived up in that area for 30 years. I have friends who lost houses. It affects me personally. So it's terrible.
Yeah, I know some folks who have lost. It's
horrible.
It's horrible.
And you're right. And no one's talking about the underinsured. And so you have SBA and FEMA who can make the loans, but you have these these houses and generational wealth that have now dissipated because they don't have the they don't have the ability to make those monthly payments on those disaster loans.
Yeah, it'd be interesting to see, because most of those, if you have a mortgage, you generally have to have insurance. So I don't think the bank losses are going to be anything to really talk about. It's just going to be, unfortunately, largely on the folks that are underinsured.
And there's a lot of them.
We'll wrap it up, Josh. Wrap it up, Bob.
That's it. I love you guys, what you have to say. And John, you do a great job on putting together this panel. So
we'll bring this group back again, probably in about 6 or 7 months. And our next webinar is probably going to be on C&I. So stay tuned. Goodbye, everyone.